The following podcast was recorded on Wednesday, February 23rd, 2022, featuring Jim Bianco of Bianco Research. To hear the podcast in real time, you can sign up for a free trial at biancoresearch.com or arborresearch.com, or by emailing Gus Handler directly at gus.handler@arborresearch.com. You can also call Arbor Research and Trading at 1-800-606-1872. Thanks for your time and enjoy the podcast. Welcome, everyone, to the latest edition of our podcast series, Talking Data. I'm your host, Kristen Radosh of Arbor Research and Trading, joined today by Jim Bianco of Bianco Research. Welcome, Jim.
Thanks for having me.
Today, Jim will be discussing the yield curve's message and what the message is signaling to the market. Jim, the yield curve continues its relentless flattening with short-term rates rising. What are the latest market signals telling us?
Yeah, so let's go through those market signals, what they are, and then we'll add some context to it. So the first chart we're going to show here is the yield curve, the 2-year yield less the 10-year yield spread. And you can see that it is narrowed from back about a year ago, March 31st of last year, when it was at 158 basis points. It's narrowed all the way down to 38 basis points. And I've got some markers on that chart. It was 90 basis points less than 2 months ago. It's 38 now. And at the beginning of the month, it was 63 basis points. It's 38 now. At this rate, the Fed meeting is 21 days from today, the day we're recording, on Wednesday, the 23rd. The yield curve could theoretically invert before that day. Now, how is the yield curve inverting? Is we'll go to the next chart. Short rates are continuing their relentless rise higher. They've turned around big in the last couple of days. They've now traded the day we're talking above 1.6% in the 2-year note. This is the 2-year note yield. And we're setting new highs. Notice that this yield was 21 basis points back in September, and it was 75 basis points at the beginning of the year. It's 160 now. And you can see that the chart has been basically going straight up. Now, what's been driving short rates up is the next chart, or the next one is a table, actually. There are still 7 rate hikes priced in for this year, despite, as I've talked about in this format and other formats, pretty much everybody on Wall Street is convinced this table won't happen, that the Fed will do something less than that table. And by the way, they're not calling for a recession. That's the quickest way to get the Fed to stop raising 7 times is you have a recession, you kill demand, and you kill inflation. They're saying that without a recession, nearly 100% of Wall Street thinks that they're not going to have 7 rate hikes this year or 8 rate hikes in the next 9 as well. And I will point out, if you look at the first couple of rows on this table, the March meeting, the May meeting, the June meeting, there are 4 rate hikes priced in for the first 3 meetings. Now that vacillates. If we go to the next chart, that 4 rate hikes over the next 3 meetings means one of them has to be 50 basis points. Now, you can see on this chart, will it be the March meeting? Well, right now, there's more chance, a 67% chance, the Fed's going to move 25 basis points rather than 50. That's the blue line being above 50% and the orange line below, although they've reversed a couple of times. But nevertheless, whether it's March, May, or June, the market, since the inflation report in February 10th, has been pricing in one of those meetings is going to have to be 50 basis points. So the yield curve has been flattening because short rates are rising, and the market is pretty much dialed in on this idea that there's going to be 7 rate hikes and 50 over the next 3 meetings. Now, if we go to the next chart, it shows long rates. Now, long rates, they're trending higher. There's no doubt that they're trending higher, but nothing like short rates. Notice that March 31st, when the yield curve was 158 basis points, the 10-year note was 174 basis points, and today it's 197 basis points. So it's only 24 basis points higher than it was roughly a year ago. The 2-year note was 20 basis points around that a year ago, and it's 160 right now. And this is typical of the way that a yield curve inverts. Short rates go up, the Fed's going to get aggressive. Long rates meander sideways-ish, maybe with a slight upward tilt, but there's more worry that the Fed is going to go too far. If we go to the next chart, just to round this off of what's been going on, this is the terminal funds rate. This is the animal that we look at. Okay, where's the Fed going to stop raising rates? And this is just the forward curve of the Fed fund futures. You could use OIS, overnight index swaps. You can use the repo market, the Eurodollar futures market. You're going to get the same answer. And you'll see that in June of 2023, it says that the forward curve is going to be 2%. In December of 24, it's 211. It peaks at 225. So 8 rate hikes basically gets you to the terminal rate. So what the market is trying to tell you is the Fed is going to go, starting in March, really hard, maybe at 50 basis points out of the gate, 7 or 8 rate hikes in the next year or so, and then they're going to be done, is where they're suggesting. Now, there's 2 ways you can look at this. Way one, oh, that's not so bad. They're just going to raise the rates to 2, and then they're going to stop, and everything's going to be fine. Or if we go to the final chart, which is the long-term yield curve, all it might take with the major flattening of the yield curve is to move the terminal funds rate to 2, 7 rate hikes to invert the yield curve. What this chart shows is going back to the late 1960s, the yield curve is 8 for 8 in predicting a recession. 8 times the yield curve is inverted on a persistent basis, and 8 times a recession is followed thereafter. The one nuance on this chart, if you look closely, is September 22nd, 1998. The yield curve only inverted 3 different days, no more than 9 basis points in any one of those 3 days. It wasn't persistent. What I mean by persistent, if the yield curve is below 0 for 10 straight days or a month, the yield curve is 8 for 8 in predicting recession. If it trades 1 basis point for one part of one day and 2 basis points for one part of another day, and that's it, that's not a persistent inversion. So persistent inversions have led. So at least from what is the market signaling? Short rates are going up. The Fed's going to be very, very aggressive in raising rates. Long rates are meandering sideways. The yield curve is flattening. It has gone from 160 basis points a year ago or 92 months ago down to 38 basis points and continues to make new narrows. And if it was to get to inverted, it is not inverted now, but if it was to get to inverted, that would be a signal that we might be leading edge of a recession.
So Jim, what does this all mean and why is this cycle different?
Yeah, so what it is that the yield curve's message is that there is a stress building in the system. Now I use that generic concept. What does that in the system mean? Well, it can mean that the economy is slowing down quite a bit. This is why long rates rally in a risk-off rally. They sense that inflation is peaked. It's not a problem because we're killing the economy, and then long rates don't rise as much. It can mean that financial markets are under stress and could create a reverse wealth effect. Well, the day before we recorded yesterday, we had from close to close a 10% correction in the S&P for the first time since the pandemic lockdowns of the spring of 2020, as well. So it could be that the financial markets are predicting it, or it could be a problem with the plumbing of the market. And we've seen that in September of 2019, we had a problem with the plumbing of the market. The repo market was a problem. The yield curve inverted the yield curve inverted in the mid 1990s, 1994, 1995. We had a problem with the plumbing of the market then. We had debt moratoriums, which was known as the tequila crisis. Granite Capital, which a big mortgage hedge funds failed. Kidder Peabody, which was a brokerage firm, failed at that point as well too. In Orange County, the municipality was running a levered fixed income bet with their pension money. They wound up having to get bailed out as well. So we had tremendous plumbing problems as well. So when the yield curve inverts, it is a signal that something is broken. You hear people say this all the time, that it means something's broken. It can mean the economy, it can mean the financial markets, it can mean the plumbing, it can mean some combination of those. Now, why does the yield curve invert? Because the Federal Reserve has a problem. They can identify the issue in too much inflation. They can identify their tool as what to do about too much inflation, raise rates. They cannot identify when they have solved the problem. So they keep raising rates until something breaks. and that something breaks could very well be the economy or the financial markets or the plumbing or something else. And the signal that they have gone too far and potentially have broken something can be an inverted yield curve. Now, what's unusual about this cycle is we're 3 weeks away from the first rate hike. Now, the overwhelming consensus is the March 16th meeting, there will be the first rate hike. We're just playing the game as to whether or not it's going to be 25 or 50 basis points. Well, at the speed that the curve is flattening, we could be at zero inverted before the Fed even starts raising rates. And it could be a signal that we are going to break something. So I think the problem that the Fed has is, and I've talked about this in other venues, their priority, I believe, is now inflation. The reason 99% of Wall Street cannot believe the Fed is going to raise rates 7 times is they still think the priority is growth, because it's always been growth, because we've never had inflation. But now that we've had inflation, I think the Fed's priority is going to be inflation, and they're going to raise rates aggressively. And if that creates problems in financial markets, well, that's why you get paid the big bucks in order to manage a fund as well. You just don't need, the Fed's not there to make your job easy in 2022. And that is hard for people to understand. The Fed is not going to have my back. They're going to try and deal with the inflation thing. But the market is so worried that the Fed is going to break something, we might have the yield curve close to inverting before they even start raising rates. And so this is a story that transcends everything else. I picked the yield curve to talk about this week because obviously the big story this week is Russia and the Ukraine and what's happening there and the potential for sanctions and war. But whether or not that is something or nothing, and I'm talking about from a financial standpoint, whether or not it's something or nothing, whether or not we do enough sanctions that it alters the financial markets, there's a problem with the energy markets with higher prices, some kind of a supply constriction because of what's happening with the war. There might be, there might not be. That sort of situation is so fluid, it's hard to say. Whether or not that is the case, what is the case is the Fed's going to hike, the yield curve is flattening, and it very well might invert. Whether Russia-Ukraine turns out to be a big deal, the yield curve is the story, that story doesn't change, or nothing. The yield curve story doesn't change. So looking past, what does Russia mean for the markets? Curve's going to invert. Fed's going to raise rates a lot. The only way that this is going to change, I think, is if you can make the evidence that we've already busted something. It's clear we're going to have a recession. That is going to kill growth, and then we don't have to worry about inflation anymore. But I've used the analogy before. It's like I go to the doctor and I say, you know, doctor, I got an infection in my leg, and he pulls out his bone saw and says it works every time. Well, that's kind of not the way I wanted you to fix my leg. You know, we could create a recession. We could bust the economy wide open, and we could get rid of inflation that way. But that's kind of not the way we want to do it. But that is what I think is the underlying toe in these markets that they are worried about. And that signal that is telling you that that worry is growing is the flattening yield curve. It is not inverted. It is not signaled something is broken, but it can relentlessly continues to move in that direction. And as long as it does, it gets to become a bigger and bigger, it should be a bigger and bigger concern that it's telling you something's not right and that we're going to have a problem if we see inversion.
Well, thank you, Jim, for your thoughts today, and thank you, everyone, for joining us. As a reminder, Arbor Research and Trading is an institutional research and brokerage firm. Our 2 most prominent offerings are Bianco Research and Arbor Data Science. For further information or any questions, please contact Gus Handler at gus.handler@arborresearch.com. Have a great day.